It's been an amazing conference so far. Really appreciate everybody being here. My name is Kyle Sonlin. I'm a co-founder of STM, and I'm so thankful for the whole STM team, for all of our partners and sponsors, for the Knight Center, everybody here. So just to get everybody awake, can we give a round of applause to all of you for being here? Panel. All right, let's get the blood flowing a little bit. This is going to be the best panel that you've had all day. That's because we have some amazing innovators here with us. It's not just me here on stage, even if you wanted to hear me the whole time. So I want to at least give everybody a quick opportunity to introduce themselves before we get into an awesome discussion, kicking it off with Lou.
Hi, everybody. My name is Lou Morgan. I'm the Chief Technology Officer at Black Time Financial. We're an infrastructure provider at Digital Core.
My name is Jeffrey Vier. I am the head of tokenization at Republic and Republic Crypto. Republic Crypto is a Web3 advisory services business. It also executes tokenization for those Web3 founders. And then I also am the head of tokenization for Republic, which is a regulated crowdfunding portal.
Brian Anderson, CEO and founder of Raze. We are a traditional kind of fundraising platform for private placement deals, and we've built a security token engine to allow any company or early stage fund to be able to launch a security token offering. We're excited to be here.
Sid Powell, co-founder and CEO of Maple Finance. So we are an institutional lender and lending platform. We launched about 3 years ago. We've done $3.5 billion in loan originations. Mostly these are commercial loans to funds, trading desks, and on the other side we have high net worths and family offices who use us as a yield product. But Australian by background and reform banker, so happy to be here.
Yeah, so the panel discussion today is about tokenization trends in the market. And so we want to talk about how this industry has grown significantly over the last 5-10 years. But it's also, I have a bunch of questions for each one of you specifically that we can dive into some of the cool things that you all have going on. So first off, and maybe we can start with, let's start with Jeff. Could you tell us a little bit about where Republic is the leader in equity crowdfunding and has been doing that since the Jobs Act of 2012. We've seen a lot of private capital markets activity. What excites you about tokenization, and where is that playing a part in that existing business model?
Yeah, so 2016.
Yeah.
Oh, Jobs Act, yes.
Jobs Act 2012, 2016.
Yeah, so yeah, Jobs Act, that allowed for regulated crowdfunding, which is effectively selling private securities, equities, safe, future equity to non-accredited. That's honestly, like, that's the piece that got me excited about joining Republic. There's a couple of other things, but we weren't really, or I wasn't really seeing a lot of democratization of access to digital assets and financial assets and early investment opportunities that are typically reserved for venture funds. And when you're buying something in a public platform like a Robinhood, you're getting the worst price, right? And the governments of our world are telling you that if you are not accredited, if you are not making $200,000 a year or worth $1 million in assets, then you are not sophisticated or smart enough to invest your own money, which is really a problem. So Republic has had a kind of a long journey with this. Actually, Republic was born in 2016. Republic Crypto was born in 2017. And it was really kind of taking witness to what was happening with ICOs. So ICOs has a little bit of a stain on the crypto industry because there's a lot of scams and rugs that were happening during that time. But fundamentally looking at it, the founders of Republic were saying, this is incredible fundraising technology, right? Like, look at the speed at which you're able to capitalize these new ventures. So Republic Crypto was born at that time. And then those two businesses have kind of been running in parallel up until this past year, after 4 years of working on the Republic Note, which is it's our effectively digital index of all of the raises we've done on Republic, as well as investments that we've done through Republic Capital as a on-chain token. It's on the Avalanche blockchain. We launched that. We had sold that to retail over the course of those years. And that was really the merging of Republic back into kind of its original vision with 2017 and kind of bringing that technology to the masses in the way that we saw fit. And we did that also with the launch of the Republic wallet. So on republic.com, we also have a self-custody wallet, which is very important to us. You can actually go on republic.com, create a self-custody wallet. You can take custody of digital securities as well as utility token offerings that we do on that platform. And that's kind of the merger of us coming back together at Republic with, digital securities, having all that infrastructure, launching our own asset. Yeah.
Yeah, so that, I guess maybe that starts with the question, and I'll just ask you a follow-up there, which is why now, right? Why is Republic now getting into tokenized securities and capital markets infrastructure as opposed to just doing some of the crypto integrations from the beginning?
Yeah, so I mean, maybe it's a little bit of serendipity, slightly, with just like being like ready to launch the note. That was really, we were going to launch the note no matter what, right? The timing is really great because we have all these other amazing businesses that are kind of bridging the gap between us where we are with retail, and we also sell to accredited, and we'd also do some interesting structures that are not just non-accredited retail, but the industry has really matured. This is the first time we've really seen, security tokens or RWAs on chain be popularized during a crypto bull market, right? Like, when's the last time you went to like an RWA event off market, like on market? It just wasn't happening. And now these things are largely coinciding because of the technology that was born out of DeFi being ingested into what's happening with security tokens and like security assets on chain in regulated markets.
Yeah, no, I mean, look, you're preaching our language here at STM. We've been working hard on this stuff about the same time as Republic Crypto has been working in the industry, and for so many years it was, as I had said before, you're talking at a wall, basically. Not a lot of people really wanted to hear about real assets, real investments, real infrastructure for real capital markets, and now it really seems like an amazing time to do that.
And I'll just say too, like, I was that person. So like 10 years building on blockchains, really working on fringe stuff. My venture studio had launched what we called the first anonymity exchange, but it was really the first DEX. It was Litecoin, Bitcoin, don't need to know who you are. And after reading the white paper for the Republic note, I was instigated to join Republic and take this role on because I was like, I think I can bring a lot of that ethos to this, but I was that person.
So you talk about evolving markets. I want to pass it over to Brian. Brian, you spend so much time working with early stage issuers as well as venture style of investors, and this market has grown significantly, both in terms of the adoption rate as well as the terminology that we use. So could you just like set the scene by talking about the difference between tokenization and like issuing an offering or issuing a secured token offering, how those things have evolved over time and what we're seeing now in the market?
Yeah, I mean, I think we can all probably have different flavors of this definition, but tokenization to me is taking any kind of asset, right, and turning it into a token at its most basic level, digital, physical, whatever. The problem is that you mentioned ICOs. Wouldn't it be great to take a token and then be able to go raise money on it, right? Everybody had that great idea a few years ago and didn't turn out well. And it's actually still not doing very well across the world. There's still plenty of rug pulls and all that stuff. And so we looked at Raze, we looked at the private placement space, and we said, gosh, everything is super paper-based still. Everything is really, really archaic. Like, the public markets have evolved so much digitally. I mean, just open up your phone and look at Robinhood, right? It's unbelievable the access that you can get with an app like that. But in the private markets, it is so archaic. So when you look at an STO, it is this first big, huge step forward to be able to take any kind of asset and actually put it on chain and actually raise money with it, turning it into an actual offering, hence security token offering. So it is truly the first step to being able to actually raise capital on something that's digital as well as on chain. So
there's this capital component, and then there's managing the cap table component. So in terms of the clientele that you're seeing and the leads that you're working with and the businesses and the opportunities, do you see those as two different business models, or is it kind of one leads to another? Or, how can we bring these assets on chain the most effectively? Is it via fundraisers?
Well, I think that, I'm just going to selfishly speak about, our industry, right? And
Fire away.
Where we're at, right? The simplest way that I look at it is you've got a very, very messy situation with cap table management. Okay. Yes, there's Cartas out there and other companies that do it really well that are on proprietary systems and things like that in their company. But at the end of the day, the whole benefit and why all of us secretly love to get into crypto and trade crypto and buy tokens is because not only the access to it, but the liquidity and the ease and the token, right? And when you take a look at your cap table, me as a founder, I've been a founder a couple of times over, and I think about the fact that a spreadsheet is still how most people actually manage their cap table. I mean, it's just the truth, especially early stage. And it's unbelievable how complicated it is to go from a safe agreement to a subscription agreement, price around equity, converting your equity. You might have convertible notes out there, and you've got all this complex, convoluted representation of your equity in your company. And most founders honestly get so lost in being able to figure out what they actually own that by the time they go to a Series A, they've pretty much lost their company. And we hear that time and time and time again. But how great would it be on the early kind of issuance process of raising money and starting your company if you could say, okay, I've got 10 million shares and I'm going to send, 100,000 to my co-founder or this person, et cetera, and I'm going to send them in a representation of tokens on my cap table. And then I'm going to start raising money, and every single transaction from that point forward is immutable. It's trackable, it's traceable. Isn't that what blockchain is all about, right? Is being able to actually trace those shares and track all that stuff. And so if we can do that with a cap table, we can do that with so many other different types of industries. So going back to our industry, though, we're still not there, right? And we're trying to get there, but the technology is already there. And we're fighting about regulation, but we already have the technology to do what I just talked about, which is taking shares and putting them on chain.
What do you think is the difference between that and, issuing tokens in a protocol and having them float around?
Oh.
I know there is one.
Yeah, huge difference. I mean, it's from a regulatory standpoint, from a legal perspective, I can't just go sell my shares to just any retail investor unless I actually do it a certain way in the United States, right? So if I want to do a Reg CF, I call up these guys at Republic, and I'm going to do a listing on that way. If I want to do a private placement listing and I want to actually raise capital with accredited investors, right, I'm going to go through somebody like Raze. But those shares are now locked up for 12 months. I can't do anything with them as an accredited investor. Whereas tokens on a blockchain can go out in the wild, get on a DEX, go on chain, be traded across the world, and that's why we all love tokens. But the SEC doesn't like that. And most people in the United States, I don't think that's going to change anytime soon from a securities definition perspective. So we're trying to play within the current rules of the current framework right now and sit in that and say, we can actually bring this technology in the current framework of securities law.
So we'll kick it back over to Sid, and we'll start going your way. I think that the BlackRock news caught everybody. And that's certainly been really exciting, is that they're working in this tokenized treasury space. And I know that you do a lot of loan originations, and I know that you work with these types of vehicles. Could you just help us understand from the companies that's providing some of this infrastructure, and you're not necessarily working directly with them, or maybe you are, but regardless, why is that the rage right now, and what does that mean for the general market?
Well, I think so BlackRock coming into the space is obviously a really big deal. They're a massive player. They have huge distribution, and so it really signals a lot of positives for the future of the space. But the product was all the rage last year and into the early part of this year, which was tokenized T-bills, because crypto native companies were kind of blocked from access to banking facilities through Operation Choke Point. And so that meant if you had raised funds from venture, and you had stable coins. You couldn't go and off-ramp that into a bank account because the banks wouldn't take you as a customer. So the space produced an on-chain solution, which I think is like, it's what markets should do. They should come up with a solution where there's a need, and this was tokenized T-bills. And so that, hit more than 800 million in decentralized issuance on-chain in 2023. I think that was a huge milestone. And so seeing BlackRock come into the space, I think signals, one, institutional adoption, but also that they see a really attractive market here. And so I would say you're going to continue to see new forms of tokenized assets or tokenized credit, which is what we do. We do institutional lending on chain. And so we saw a huge demand uptick last year. But as somebody who's building in the space, I also don't love the competition, right? Like Peter Thiel always talks about, you don't want to be in a market with a lot of competitors. Competition is for suckers. So for us, that meant we started looking elsewhere and looking more at just direct lending rather than doing tokenized T-bills because there wasn't a lot of margin in that anymore, and you're one of 15 competitors.
So talk about those products that you're working on now and how you see that really driving the future, because presumably they're going to keep following your trail of cookie crumbs.
That's right. I think they're going to continue to sort of chase chase new products in the space, which is good. It's better for the consumer. But what my job is to find something they're not doing and then go and offer people that. And so what we tried to do was direct lending. So everyone would be familiar with companies like BlockFi and Celsius and Genesis from last cycle, but with them being out of the space, there's a clear gap where a lot of people want to borrow against Bitcoin or ETH or Solana, and a lot of people want yield on the other side from lending against those products. And I think it can be done in a relatively controlled and risk-managed way. But where I see companies like ours being able to work with really big firms like BlackRock with their BUIDL fund, and Franklin Templeton and Wisdom Tree and some of these others who are tokenizing funds and assets, is taking them as collateral. Like if you've got one of these tokenized fund units like BUIDL, there's no reason that we couldn't extend you a loan against that, and that way offer some kind of partnership as a sort of complementary. Like I'm not going to beat BlackRock at their own game, but I can offer a complementary product that they can't do yet.
Makes a lot of sense. And our last panelist here to keep everybody engaged, Lou, you really understand a lot of the technological infrastructure with some of these components. So can we talk about blockchains and what that technology means for the financial asset, and how important is it to pick a good blockchain, or is it important? Can multi-chain assets exist? What's your perspective on using a distributed ledger with real regulated assets?
Yeah, I think the blockchain brings a huge operational efficiency to transactions, and we're seeing that with the big adoption from BlackRock and Franklin Templeton. Choosing a blockchain is interesting. I'm going to hedge here, a little TradeFi term, but choosing the correct blockchain, yes and no. There's you really want to choose a blockchain depending on the item that you're tokenizing. All right. So if you're tokenizing a regulated asset that needs compliance, and you're going to want to choose a blockchain that suits that and has those policies built into it. You're also going to want to take into consideration, is this asset going to trade once? Is it going to be issued and then sit in a wallet forever? Or is it going to trade a lot? Is it going to be transferred a lot? Those differences make a big part in your blockchain choice.
And then how important then also are like the integrations that come with the different chains?
Yeah, that's big. You want to pick a chain that's got enough features for your product. You're going to want to pick a chain that has a lot of validators that are trusted. You're going to want to pick a blockchain that has ease of access. So if you don't have a platform, but you want to access the ledger, you're going to want something that's has an easy way to do that, right? If I'm a, an asset holder, a digital asset holder, and I don't have, maybe I have one, right? Is there a good blockchain explorer that I could just go and grab my balances off of?
Can I take the devil's advocate here? If
Please.
you look at the largest institution who just issued a regulated product, I don't think they chose a chain based on any of those aspects except liquidity.
I'll play the devil's advocate back at you. There's a couple of things that here in the United States, the SEC has asked of digital token issuers in that the assets have to be able to be clawed back. They need to be able to be frozen. There's only a couple of layer 1 blockchains that have that ability built in. Now, you could do that in a smart contract, but that's getting into some fairly technical smart contracts. So, yes, and yeah.
When you say liquidity, are you meaning?
Yeah, I was just meaning like they picked the chain and they picked the one that had the most liquidity.
That has the most
Right,
purchasing
that doesn't
power?
have those clawbacks.
Do you think BlackRock was making their liquidity decision based off of which blockchain facilitated that?
I think they chose the blockchain with the largest liquidity. Yeah.
Yeah, I don't think that's
I
wrong.
think otherwise they would have done like Daml or something.
They're just so macro-headed that they're looking at where the purchasing power exists at that moment in stable liquid form or
I think they looked at distribution.
just distribution.
Which could be
Yeah.
integrations, right? I mean,
I would-
integrations is a
AWS.
form of distribution.
I would agree with that. And it was the safe choice, too, right? Nobody
Yeah.
was going to get fired because they chose the chain they did, right?
So, Lou, we'll keep it with you. One more question. I just want to hear, since the panel is the future trends in this market, where are we going in the future? I mean, maybe we can bring Sid in on this discussion too, but and anybody else on the panel. But in terms of, is this going to be continued to be segmented styles of blockchains, and you're just going to have to hope that the one that you chose is going to be the most relevant one in a few years, or how do we see this moving forward?
No, our clients are all hedging. All right. I personally see that the landscape kind of evolving around multiple blockchains being used for multiple different types of tokens. As I alluded to before, if your token's going to trade a lot, you're going to want to be on a chain that's going to is fast and efficient and cheap, right? If your token's only going to trade once at issuance and sit in a wallet, you can do it on a super expensive blockchain that might have some features that the issuer wants. So I don't see, there'll be, this is gonna go back to, the guys that thought maybe 20 mainframe computers would run the world. I'm gonna go out on a limb here, but there's gonna be a heap of blockchains, maybe a dozen, that are gonna host a lot of these tokens. And the issuers are gonna pick between them, and they're gonna pick based on their, what their needs are.
And one of those needs, primary needs, might be liquidity.
Liquidity.
Yeah, I know I took the devil's advocate position, but yeah, I do think there will be multiple blockchains that are specialized, whether it's for hosting things like RWAs or NFTs or gaming,
Yeah.
or what have you. Like I don't think we're all going to coalesce to one blockchain.
Brian, do you see your interface talking about blockchain and tokenization very much at all? Or do you see yourself more as the interface with which someone can get involved with the underlying asset that then is powered by the blockchain infrastructure? Which one do you see as the future adoption point?
I mean, definitely the latter. I mean, I was in college in 98 to 02, and so I was in college when the dot-com thing went way up and then crashed and burned, and then the actual real kind of innovation started, and all the companies we know today happened. And then we were talking like we were a bunch of blockchain people. People were talking about this company and that company and this protocol, and whether email is actually going to work, et cetera. And all it was very technology focused, which is normal with innovation. But now today we don't really talk a lot about that stuff. It's just an assumption that you're on the internet, right? It's kind of silly to even talk about anything different. I think that's where we're headed. We look at raising money and issuing securities in the capital markets, especially the private markets, is always going to involve investors and issuers, right? A buy side and a sell side, right? How you can actually empower that, make it faster, cheaper, better, make settlements faster, et cetera, is all just technology improvements. And so the way we look at and the way we talk to customers, and almost everybody I'm talking to now today, whether this is a good thing for our business or not right now, is that, of course, we want people that jump up and down and are like, oh, I want to do a security token. That sounds great, but that's just not the reality that we're in. Instead, what they're saying is they're hinting around the question that we kind of pull out of them, which is they've been trading in crypto personally. They're Bitcoin holders. They believe in it, and they want to know how they can actually issue a token themselves, how their company can issue a token, or how they can tokenize some asset like real estate, but they're too hesitant because they feel like it's illegal in the United States, or it's just not technologically possible, and it's simply not true. It's all here. We can do it now within current regulation and within current technology. And so what we're telling people is, go do what you're going to do, and then here is what will benefit you if you tokenize. If we can plug into one or more ATSs and create a secondary market, we don't have to create the secondary market. They don't have to create the secondary market, but the technology provides a bridge to be able to have that secondary trading, which will then just create an adoption.
That was a really great answer. I agree with what you're saying there. And I was just, while we were hearing that, I just wanted to hear from Jeff on this one. Can you talk about the decision to choose the blockchain that you worked with and how you reached that decision?
Yeah, I mean, we really chose the blockchain that we deployed onto, which is Avalanche, because we had an incredible relationship with that team.
Great
and
team.
with that technology and what they were building as far as a public blockchain that was going to have composability for private markets. For me, that's probably the reason that I was encouraging that decision.
Could you talk about those 3 points, just like say those 3 again?
Yeah, so it's, you have a public blockchain, it's got public validation.
Which is important for what reason?
Well, it's important because it's going to eventually have the construct to reach out to the edge. So, like a lot of people are saying DeFi when they're having an RWA conversation, and I think it's the wrong word to be using because it's effectively not that. It's not decentralized finance. It is a walled garden, and that's where it's going to start. But the way it's going to go is you're going to have walled gardens, and with Avalanche, those are subnets. Those subnets are going to start to talk to each other. They're going to start to exchange things like KYC passports. They're going to start to exchange things like liquidity and market making for the assets that exist inside those subnets. And then, as it starts to grow, you're going to have more decentralized finance-like activity. You'll be able to coalesce things like liquidity for market making and actually settling those trades of in this case, security assets, much like DeFi. But you're always going to have that kind of element of KYC.
Like the semi-permissioned or
yeah,
whatever.
It's kind of that crawl, walk, run. The elements are all there out in front of you. Now it's about populating those elements and getting them to a critical mass where you can start to kind of like lift the chicken gates, and let these things kind of move between each other. Obviously, there's a lot of things.
So that's public. Then we had, what were your other 2 prongs? Composability was another one.
So I'll get to composability. Maybe I'll just talk about compatibility first.
Sure.
I won't name names, but we had actually gone down a route with a non-EVM protocol for a long period of time, and it just became very burdensome at that time. Obviously, a lot of non-EVM blockchains have moved into the space and doing incredible things, and we're working with them, and we're really excited about that. But at the time, there was a reliance and a comfort with going the compatible route of EVM. When you're issuing EVM, it's really easy to also think about those assets being composed on other EVM blockchains.
EVM standing for Ethereum Virtual Machine.
Correct. Yeah, written in Solidity. And then for composability, I mean, composability is really kind of blockchain agnostic, in my opinion. But composability, I think, is one of the critical utilities that's kind of like out there in the future. And we don't really think about it with security tokens too much right now, unless it's in like building markets. So like you could have fungible assets that are inside of a smart contract that's a pool that has a pair in it, and that pair is probably going to be a stable in like an ATS environment at first. But you can compose those assets in little markets and insulate them so they can have liquidity and trading can happen. And it can also happen inside of a walled garden, but without maybe like a broker-dealer to be inside of each of those trades. It can happen on-chain, it can settle on-chain atomic, and you can know that it happened in a truthful way. And then I think beyond that, the interesting thing is going to be the construction of things like indices. So for us, you could do this with like paper. You could take paper and then you can take all those paper records and create an index, and you can put that index token on-chain, or you can have that asset originating on-chain, and then that composability is even simpler. It's much more auditable, and you can start to construct different indices of assets, whether that's private securities or public securities or whatever it may be, and that composability. That's another reason we chose EVM. There's a lot of composability capability there, but that's honestly pretty blockchain agnostic at this point.
Great. Yeah, thanks for that. Sid, what do you look at in terms of integrating with different blockchains? Where have you found the biggest points of adoption, and how have you guys approached that subject to date?
It's a good question. So we're currently on Ethereum, Solana, and Base, and we would like to be on more chains. It's, as a small team, it definitely does drain resources to support additional chains, even where it is EVM, and that's mostly because you've then got to index all the data, and then you've got to have a front end that's connected to the blockchain, which is not super easy. But I think about it in terms of liquidity, what I mentioned before, because for us, I can't go and put Maple on 10 extra chains, just given our finite resources, and so I have to kind of prioritize them in terms of where I think the most customers are. And so typically when we look at going onto a new chain, we would try and find a cornerstone customer, in our case, who might either borrow a large amount or put in a large amount of stable coin that we can then lend out on that chain. So that's kind of how we've approached it, and that's how I would say we will continue to approach it until it either becomes super low cost for us to go and deploy on a bunch of different chains, or until we have enough resources that it's not something we have to consider and prioritize as deeply. But I would say we're looking at launching a new version of the protocol in, call it June, July. And one of the big things we thought about there is, do we go for a cost so that it's more accessible to smaller depositors and users, which would count against Ethereum L1 because that's very costly in terms of transaction costs? Or do we go and try and hit the largest amount of liquidity so that we can get maximum user adoption initially? And I still err towards user adoption initially, because as a startup, that's ultimately how you get either your TVL that then marks up and makes it easier to do another round, or your cash flows, which then contribute to extending your runway. And so it's not an easy decision, but that is kind of honestly what we look at the moment. I would love to be on more chains, and so we are always looking for new partners that can help there, but it really does hinge on having those cornerstone users. And so I think a lot of people in crypto still overweight how cool the technology they're building is versus how many people are going to buy it off them.
And would you say that that's one of the bigger differentiators for Maple in terms of your protocol stack, is that you've really tried to identify those use case adoption points as opposed to building cool technology that sounds good in a press release but doesn't actually solve a problem?
Yeah, I mean, I try and read a lot of business books, and one of my favorite ones has been Working Backwards, which is one about Amazon's business processes. And so they always start with this press release, which is where they would write what they want to release and say to the world about their product, and that has to include the benefits. And so it always has to have this kind of selling first mindset of like, what are people going to get out of using your product? And so I think that is one of the things that we, through kicking a lot of own goals in the past, have tried to do. First and foremost, we won't make a decision unless we think, we won't launch something new unless we think that there are users who are going to buy it off us. And so I think so the focus on distribution as well as the credit expertise. Like, we haven't tried to make everything algorithmic. We try to say instead, okay, we all come from banking and financial services or a credit fund background. We're capable of underwriting specialized deals, and so let's lean into what makes us different and gives us a niche and try and compete on that dimension against the other DeFi lending platforms, real-world asset platforms, and try and focus on, as much as we can, pull away from the pack in certain areas. That's why we kind of, pulled back from doing a lot of tokenized T-bills, because 12 competitors, 15 to 25 basis points in revenue, it didn't look like an attractive market, despite the size.
But that's an important product, right? Because it allows for larger treasuries that are holding stables to get a more sustainable yield, right?
Hugely important product. But there's a difference between consumer surplus, which is how much your customer benefits, and how much you benefit. If you read Warren Buffett's old letters, he'll talk a lot about how, when he owned Berkshire Hathaway, they produced textiles, and you'd invest all this money in producing the best textiles, which would help the customer, but you make no money on it. And so you gradually produce a better product as you slowly go out of business. And so I try and keep that in mind, that it's a great product. I really want it for the space. I just don't want to be the one selling it.
You want to stay in business too.
Yeah.
This is like lessons on.
I'm here for a long time, not a good time.
This is like lessons on a startup.
That great answer there. And we are about halfway through the panel, so I do want to give anybody an opportunity. If you have questions, if you want to ask any of our panelists anything, I want to make that opportunity available. Just raise your hand. I'll try to find you. I certainly have plenty of questions. We could be here for a couple hours, but unfortunately, we're only here for 23 more minutes. So, back to you, Lou. I've heard word on the street is that tokenizing the asset isn't actually the hard part. The hard part's getting people to buy it. And that seems like some of these panelists would agree with me. You have some of the technical expertise here. Would you agree with that statement, and why?
Yes, I would agree with that. And I think a lot of the panels earlier addressed this. We have a lot of people that are very educated about the technology. They would love to buy an asset, but they can't because of the regulatory environment that we're in, especially in the United States. A lot of the buyers have compliance departments that said no, legal departments that said no. We've had everything. Now, we unfortunately, yesterday, we had a great outcome in the House with SAB 121, and then the White House came right back at them and said, no, we're going to veto that. So, it's a difficult situation there. You guys have stuff to add here.
I mean, this one drives me absolutely fucking insane, if I could swear.
Oh, you can.
Well, it's like, so I look at inbound all day. I also work at a big, funding portal. I see inbound, some of the businesses actually that I see inbound from they're incredible. Like, it's like, holy hell, I can't believe this company is reaching out to us right now, cold inbound. I can't believe they couldn't find someone actually that they knew inside of our firm. And also the different industries and what people are trying to sell. It's incredible how many businesses have not thought about buy side. And they look at what's happening inside of, $3 trillion of capitalization in cryptocurrency markets, and they think, oh, there's liquidity. Like, they just do this, like, gymnastics in their head, and they're thinking, like, oh, there's liquidity here. And it's, like, couldn't be the furthest from the truth. I mean, like, you're dealing with it, right? It's like, where's liquidity? Liquidity is distribution. It's the buy side. And if you're dealing with good products with good yield, where, like, you kind of know who your customer is, we're getting businesses coming and wanting to tokenize assets that, like, really have no business being tokenized, I'm still, I'm stoked about it because they're taking an interest in it. But they think that like tokenizing your asset is solving a distribution problem. Buy side actually gets smaller because now you've
For
said,
now.
what? Yeah, for now.
Fingers
For now.
crossed.
And I mean, listen, you have to put a lot of this stuff like behind the scenes and just talk about the offering, but you're now targeting, you're saying this is the tokenized offering, you're now taking the possible distribution who may be interested in your business as it is today, as a successful Web2 business, and you're saying I'm moving it into this sector where it's starting to become confusing to you, and we see this all the time. If an offering is confusing to anyone, you've got to get like a second, and all of a sudden it's breakage and you are not subscribing to that offering. So yeah, it's remarkable. But it's also like really encouraging at the same time. It's funny. It's like, oh my God, I can't believe they're trying to do this. Why do you want to do this? This probably doesn't make sense. But it's also incredible to see how many businesses are looking at what's happening in our industry and saying, wow, there's actually a tremendous amount of capitalization. Maybe they're interested in buying my business as a token. And they're spending the time to get on the phone and learn with us. And maybe realize that it's not the right opportunity at that moment, but something they want to explore further down the road.
Right. And so this is kind of a question for you and Brian, because I think that throughout crypto, a lot of the general narrative revolves around institutions. And while large asset managers, allocators, these types of individuals, they can make a significant impact, both of your business models do focus around smaller companies and smaller issuers. So just wanted to kind of create an open dialogue and hear what your perspective is on that market, and how that's been going, and maybe some of the challenges and what that looks like moving forward as well.
I'll start.
Sure.
Yeah. I go smaller than you, so I go all the way down to non-accredited CF. So,
Well, I would just say this, Reg D, for example, for like a traditional private placement raising capital as a private company, it's depending on which stat you look at, which year, it's around 2.6, 2.7 trillion. That's kind of big. Right? That's on an annualized basis. That's enormous, right? And so I look at these kind of private companies, and I look at from everything from pre-seed, seed rounds, Series A, Series B, and then you start getting into, I'm not even talking about real estate. I haven't even gotten to real estate, right? And you start talking about companies that are going to go back out to market and raise money that have been well established. We're not even talking about small businesses. The small business market in the United States is enormous, right? They're many years from tapping into this right now, right? But if we provide a pathway for the traditional kind of Reg D issuance that are raising capital in the tens of thousands of companies, and we can figure out how to give them a better way to be able to get access to capital. I look at tokenization as much as a technology innovation as I do as a marketing improvement, as an ability to be able to market your deal differently, to be able to attract different types of buyers. Forget whether they're accredited or non-accredited, right? That's a regulatory thing. But can you open up new buyers to your deal that you currently don't have? Because if you're sitting there as a company that maybe is I don't know, you're trying to raise a few $1 million or whatever, everyone knows that to raise money, it is extremely expensive and almost just as expensive to raise $500,000 as it is to raise $8 million or $6 million, right? So guess what everybody does? They try to raise way more than they actually need because they don't want to have to go through the pain of having to do it again.
Understandable.
What tokenization does is it brings the cost down, theoretically, the cost way down to where you should be able to raise $250,000 or $100,000.
I was going to say, I mean, if you look at one of the most successful raising companies in crypto, it's probably Ripple, right? Like they have the token that they can sell in parcels near constantly throughout the year, and it's because, they effectively tokenized it and then created a liquid market for it.
yeah, seniorage, right? They're creating the asset and selling it and making money on the creation of it. It's like the origination.
That's right.
Yeah, exactly.
Yeah.
Yeah, I mean, I don't know. Like, I don't know if I really have much to add to that. Like, tokenization at a smaller check size, I think it becomes really interesting. It's secondary markets too. It's another misconception around liquidity. People, was at a Chainlink event last night. I don't know if James is in here. Probably not. James from Chainlink showed the. Actually, you were right. You were on the panel just after that. He showed this like South Park episode where there's like underpants gnomes, and step 1 is steal underpants. Step 2 is like a question mark, and then stage 3 is profit. And I think that's how a lot of people think when originally when they were coming into this space for private securities, private equity, tokenizing them. It's like, first I'm going to tokenize this thing, and then if something happens, and then like I'm going to have more liquidity. And it's like, not exactly, but there are raise limits that you need to hit based on investor classification. So like, you can only, and you only really want to make a check size into a primary offering so small. But once that goes to secondaries, let's keep in mind that that is a, let's say it's an EVM asset, it's 18-point divisible, like that thing is a hyper divisible, hyper fractional capable asset. You can sell that down to a really small check size in the secondary market. So not only was it small and, I call it like a Reg CF offering for $500,000 and the check size was $1,000 to come in, but once that asset is unlocked, you've moved it to an ATS. If it was a pretty attractive company or someone's making a bet on that emerging market, they could come in and perhaps scoop up, dust of that asset for a very, very small amount of money. They could be investing $5, $10, $15 and picking up fractions of that security on chain. So like that's kind of one of the cool things that I'm seeing on like Reg CF platform, regulated crowdfunding platforms.
Love that. All that is really, really great. And since we do have some awesome people in the audience that really cover the map in terms of potential clients to work with, people that you'd like to see, as well as we are live streaming this, so this will be long tail as well. I want to give a couple minutes just to allow everybody to talk about what they're looking for in potential clients, or if somebody in the audience that you'd want to work with, what's the ideal type of person that you want to meet with and who you want to come to your company? You want to start with you, Lou?
Sure. Yep. So Black Time Financial, we provide a digital asset core solution, not unlike a banking core from FIS, Jack Henry, Fiserv, Broadridge. So that's what we do, except for digital assets. So our target market is investment bankers, broker-dealers, fund issuers, anybody that's making product. We have branched out into industrial use cases. We really focus on a regulatory compliant platform. We try to provide as much information for our clients to give to their regulators, whoever it may be, so that they can follow the path of the asset, the account, what have you. That's Black Time Financial in a nutshell.
Great. Jeff?
Down the line. Who we look for? I mean, we operate a bunch of different businesses. Like if you are a emerging protocol, we want to do node infrastructure services for you. We run node infrastructure on 40 plus blockchains. And so we have a variety of different businesses. Runtime is our business for node infrastructure. We have an advisory services business. We love working with Web3 founders who are launching like native cryptocurrencies. And then as it relates to kind of this week and talking about RWAs, we really want to talk to cultural assets. Cultural assets, we would consider things like sports and entertainment. So entertainment's like music and sports are like sports. Soccer is a sport, basketball, sorry. Those assets are very important to us because they come with very impassioned fan bases that are typically retail, right? There's a large non-accredited loyalist base that follows cultural assets around the world. So what that does for us is allows for us to go to work with, say, a pro sports team, and rather than selling, one of the owners is going to sell 5% of the company, rather than selling it to, another rich white guy, you can sell this directly to your fans, and we can do that in a tokenized way. And on top of that, we can compile some type of utility or additional functionality with that asset. we think that security tokens are actually the best utility tokens, right? You're giving financial upside in a regulated way to someone in a business or a brand that they are stoked about, and then maybe that asset can go and access Web3 experiences or even IRL things like going to, maybe you never have to buy a concert ticket ever again, right? So yeah, cultural assets, I would say, is like the most interesting thing that we're looking for on Republic.com right now.
Fascinating. Brian?
I'll keep mine simple. We are looking for companies that do not believe or have struggled with trying to do a security token issuance themselves or an offering, or they see the benefits or value of being able to raise capital using a tokenization strategy. We'd love to just chat with you and like explore and help you understand what your options are in the US. And then we're absolutely looking for partnerships. We've actually already found several here, which have been incredible at the event. So hats off to you guys for doing that, for putting this together, that want to help us all work together, because I think there's plenty of business for all of us to work together on, to be able to make this whole kind of process from initial issuance to the marketing of the offer, to the settlement, to the actual secondary trading, third-party partners that are wanting to handle, being able to top off with crypto, for example, plug in payment rails. We are not trying to do everything. We're trying to just do one thing, which is on the issuance side. So anybody that would like to, do a security token offering, we'd love to chat with you.
We're looking for lenders primarily. So if you're a corporate treasury, a DAO, a family office, a fund, a high net worth, but you want to get yield, you want to do it in a relatively protected and conservative kind of way, and you want that yield in stables or BTC or ETH or Sol, that's our kind of customer. On the other side, because we are, of course, an institutional lender, if you are a fund or a trading desk and you want to borrow, then you should also talk to us. So those are two sides, primarily lenders, but also borrowers. Anyone looking for credit on chain, we're open for business.
So, you want to go?
I forgot one thing.
Fire away.
And last week we became SEC registered transfer agent.
Wow.
So if anybody is looking for a transfer agent, we specialize on the Stellar blockchain. If anybody is looking for a transfer agent here in the United States, we can provide that service with our wholly owned subsidiary.
What does a transfer agent do, Lou?
Basically what a blockchain does. It keeps track of shareholders, the owners, and unfortunately the regulators don't recognize blockchain as doing that function yet. So they still require, for some securities transactions, that a transfer agent be involved during the transfer of digital securities.
How about that? You made that connection.
You got to spend 150 grand and you get a spreadsheet, and then you take all of the stuff on the blockchain and you put it in your spreadsheet, and then you're compliant.
Exactly. Yep.
It's a good business for you, Lou.
Yeah, true. I'm not saying it's not, but we're a little cheaper than that, by the way. So
Nice.
All right, so we've got about 8 minutes left, roughly. Again, thank you, everybody, for paying attention. I know it's been a long day of panels, and while the quality here is fantastic, it's a lot to sit through. So shout out to everybody listening and watching. We do have a bunch of people live on YouTube. I want to kick it off on the other side of the panel with Sid, because the reality is that for a lot of us here on the panel, you've been in this space for a while, and some of the people that are watching or are here might be in this space for the first time. This might be their first cycle, or they may be very excited to getting involved. Brian, I know that you actually had the idea of launching your business at a crypto conference at one day back in the day. So if we have people like that are here today, I want to hear about maybe some advice on a mistake that you made, or something of where you're seeing the opportunity for new businesses, or something that you thought you knew until you brought it to market and realized that maybe something else was the better approach. So what do you have as advice for new companies, new players in the industry?
For new companies starting?
Whether it's a new company starting a service in the industry, or a new LP or financial company trying to get involved in the space, it can be pretty general.
Yeah, sure. Okay, well, I'll target it at new companies and new teams starting out. So I think one of the things we try to do too early was we try to make the product too complex. And what you got to do is talk a lot to your potential customers. One of the things we did do well was we did a lot of user testing early on before we actually got Maple to market. But even still, when we did that, what we tried to build was still way too complex by like a third or a half. And so I'd say if you're building something, there's no perfect time to launch. Try and launch it as quickly as you can. Try and speak a lot to your customers because you'll have a ton of assumptions. We did that later proved to be wrong around what we thought they would like and what we thought they would find important. And then try and trim it back and simplify it as much as possible. Even now, one of the best things we do is we hold long meetings internally, and we'll say, okay, well, this is, the belts and braces version of what we could build. And then we try and strip that back 80% and just delete as much as possible. So I'd say for any new teams, try and build it simpler, faster, and then talk a lot to your customers because they'll show you things you thought you knew.
Focus, focus, focus. We've heard that one before from many business books as a callback there. Brian, what are your thoughts?
Everything's going to be twice as hard. It's going to take twice as long, and it's going to cost.
Twice as rewarding, though. Let's keep it positive.
Absolutely, true. And it's going to cost 2 to 5 times more than what you think it is because our brains try to oversimplify things, which is good, but it's a lot harder than you ever think. And you got to be in it for the long term. Just a funny side story, and then I'll hand it over. We launched our company in May of 2022 and flew down to Consensus in June of 2022. Right. And we were so excited that week because everything was still in crypto hype mode. And I got on the plane and I opened up my phone and I got an alert that Celsius had locked up all of its withdrawals. And I had no idea what that meant at the time.
I got that same alert. I was on flight mode and then the plane landed and then I get the notifications.
Everything got really hard after that.
And my money's still locked in Gemini's earn program as well, so I feel your pain.
Yeah, that was a bummer. I mean, listen. I mean, I've been doing this for a long. Am I going next? Should I go? Okay, cool. Want to be here? Like it's going to be hard. Like you gotta want to be here in like the worst of times. And like actually, it's funny because I don't think that RWAs or security tokens or like on-chain credit pools, I don't think that they've really hit that yet, and they're probably still a lull out in front of them because it's been a slow climb up to like hitting an inflection point, and like there's probably a bummer out there on the horizon. So like want to be here, have a reason for being here, and then like just echoing, it's going to be so hard. Like working with Web3 founders on like a utility token like airdrop is like limitless. It's just like you could just go out, create a plan, be novel, be creative, and get it done. Doing things in a regulated environment is so hard. So you really want to think about, what hill you want to die on every day. I literally have to think about that every day.
Wow, I didn't mean to bring the vibes.
Was the lesson there go do an unregulated product?
Totally. I mean, you really want to know, hey, like, which part of this, which part of this schema do I really want to pour my resources into solving? To have a lawyer say, no, I'm really not sure about that, and like we think that would be ill-advised. And it takes you a long time to get to those no's often. So yeah, I mean, just really be expecting a long, hard slog of a journey, which. But
positive.
But also at this conference, you are talking to the future of finance people. So if you work hard enough and you work long enough, like you're going to be involved in building, the next generation of finance. So the payout is huge. It's not all a bummer.
I would agree. Everybody here is building the future. The future is blockchain. It's just so much more efficient. My advice to anybody that's out there that's starting is don't underestimate the adoption cycle. I think that was probably one of our biggest things. We saw this technology and we said, this is a game changer. The securities industry, the book on securities processing is a book called After the Trade is Made. And it's 500 pages long. And I've read it a couple times. Wow. And if you put blockchain into that book becomes 50 pages. That's how much more efficient.
It becomes about 302 pages. That is Blockchain Explained, your ultimate guide to the finance.
We'll have to write that
Buy
book
that
too.
on Amazon.
But I thought this that people would see this, and we would been blockchain everything in 2 years.
Yeah.
And here it is 7 years later, and we're still just getting going now. It's going to go, though. Next year, we talked about this. There won't be an empty seat in this auditorium next year.
I mean, I don't see any empty seats. Lou.
Yeah, I don't see any. There's 1, 2, I see 3. Next year, packed. You're going to have to find a new venue in 2 years for this thing. That's how I think the adoption cycle is going to go from here, especially if we get a little bit of action in Washington, D.C., at least in the United States, Europe, everywhere. They're going, and that's helping the adoption cycle. And I think the future is bright.
Yeah, the only thing I would add to that, just for the last 15 seconds, if I may, is that reputation really matters. I mean, I think that all of these guys here on the panel today and all of the amazing speakers and the great sponsors and the attendees here, we've been at it for a while. And that means not selling out. That means not cutting corners. That means doing things the right way. And I'm very, very proud and thankful to be working with an amazing team, a wonderful group of people that are here in attendance. So with that, everybody, please give us a round of applause. And we have another panel coming up because it's just coming and coming and coming, but we also have a fun after party tonight that we look forward to seeing everybody. So thank you.